Let's talk vehicle deductions. You know, I hear from accountants all the time that they struggle with how to discuss things like this with their clients to get them excited about the possibilities of tax planning. For that reason, I'm going to talk about this strategy just how I would explain it to my clients to give you some ideas. The bottom line is to be honest, to be energetic, and be excited about the tax savings, and they will be too. By the end of this presentation, I'm going to help you have confidence that you can not only increase the deductions that you're able to get for your clients through their vehicles, but you're also going to feel more confident than ever because I'm going to teach you how you're going to be able to talk through this and be protected through an audit. It's a wonderful feeling to get rid of all that fear. More money, more results for your clients, and less fear. So let's talk automobile expenses. There are two methods to deducting automobile expenses in the business. The standard mileage rate, of course, and the actual method. If you're dealing with a corporation, either an S Corp or a C Corp, then you don't have a choice. You have to use the actual method. Now, automobile deductions are insanely profitable and they can save hundreds of thousands of dollars over a lifetime. So why don't we talk about this more? It's often overlooked, and that's primarily because of the difference between compliance and being proactive. We're used to preparing tax returns where we're asking somebody what they spent on their car in the previous year. And if they don't have records, we may be forced to use the standard deduction amount. And if they do, we have to rely that that's all there is. We really don't have a choice in it. But being proactive with planning, specifically when it comes to automobile deductions, you can analyze what's going to be better for this client, which method is going to be best. And since most people have vehicles, we're taking an expense that they already have and turning it into an even bigger tax savings. The whole process starts by calculating the business use percentage of the vehicle. And so we start with business mileage. Of course, it must be tracked, and that's another story to get people to comply with that. But let's say that you drive 8,000 miles for business in a year and 12,000 miles total. We simply crunch the numbers and do the math, and we arrive at a 66% business use percentage. This number we can then apply towards all of the costs of operating the vehicle, the actual cost that is, and that helps us come up with our allowable auto deduction. Now, the current standard mileage rate is on the screen here. There is a shortcut method that we can use. First, let's talk about the standard mileage rate. The standard mileage rate is used most often because it's really easy to implement. The cost of operation and the cost of acquisition of the vehicle are built into the blended rate, and of course that changes from year to year. We have the current amount on the screen in front of you. Now, this is the shortcut method because you don't have to keep track of any receipts or expenses for gas, repairs, oil changes, etc. You simply take your total business mileage that you have tracked in a mileage log and you multiply that by 65.5 cents to get the current deduction for the year. So in our example here, we have a total of 15,000 business miles multiplied by the mileage rate to arrive at a deduction of $9,825. It's neat and sweet. It's about half of the rate that gives you credit for operating your car and the other half of the rate that gives you credit for depreciation. So it's covered in a single amount per mile, and that's what helps you write off the purchase of your car over time. Now, with the actual expenses, we keep track of all the expenses throughout the year, things like gas, oil changes, and the like. That's simply multiplied by the business use percentage for the year to get our operating cost portion of the deduction. So let's do an example here as well. Let's say that all of your vehicle expenses added up to $12,000 for the year. and you drove 80% of mileage for business, then the operating part of the deduction would be $9,600. But we aren't quite done yet. This process of spreading that deduction out over multiple years is called depreciation. So I want to define two terms first. The first term is basis, of course, and without complicating this too much, the basis is generally what the car was purchased for, minus whatever deductions have been taken as depreciation over time. They work together like a fulcrum. As you expense your vehicle each year, you're claiming depreciation, and over time the basis is going to go down as your write-offs go up. The 100% bonus depreciation ended at the end of 2022. But this year, any property placed into use after December 31st, 2022 and before 2024 is eligible of up to 80% of a bonus depreciation based on business use. Now, this will continue to decrease by 20% each year, finally ending in 2027. Now, you certainly don't have to take the bonus depreciation. That's part of the planning, analyzing what's going to give the taxpayer the lowest tax possible. So let's look at an example. Let's say there's a $20,000 trailer purchased for use in the business. Under the old bonus depreciating rules, you were eligible to deduct the entire $20,000 in the first year. Now you can use the new rule, which is at 80% of the purchase price in the first year. But it's a choice. You can also decide to just normally deduct it over the 5-year life at $4,000 per year. Now we still have Section 179 bonus expense. So how do we choose between the two? Well, let's talk about it and we'll review 179 first. Section 179 bonus depreciation is an election to take more depreciation up front than to spread it out over time. It allows you to deduct up to $1.16 million in the current year. That's the number for 2023. And it's for use in tangible personal property. Now, you can't use Section 179 in real property. Now, the rule phases out if you've acquired over $2.8 million in assets for the year. So I'm going to oversimplify depreciation. And what we do here essentially is spread that cost out over 5 to 6 years, because it depends on at what point you place that vehicle in service during the year as to whether or not it's an even 5 or dipping into the 6th year to completely write it off. So essentially we're deducting 1/5 of the basis of the vehicle, and we multiply that by our business usage percentage for each year that we're calculating depreciation. And so that number could change. 1 year business use might be 50%, another it might be 75%. That gives us our current year deduction for depreciation. So let's use a very simplified example. We bought a car for $15,000. Over 5 years, straight line, it's $3,000 a year. And you can see varying amounts of business use percentage so that we have different deduction amounts each year based on that change in your business use. So business use percentage is a really key part of this. Now, to make it even more confusing, the IRS saw that many businesses could exploit the deduction rules by purchasing very expensive cars so that they could lower their tax bill. So they implemented something called the luxury auto limit rules. And that limits how much depreciation you can claim in a single year. So in year 1, the maximum allowable deduction without bonus depreciation is $12,200. And in year 6 and beyond, it's $6,960. I want you to pay attention to what happens in the second line here. With bonus depreciation, you're actually eligible to deduct up to $20,200 the first year, and that limit applies to 2023. Now, what does this mean for our clients? Let's say they buy a nice BMW for $60,000, and that number becomes the basis. You divide the basis by 5 years, then you figure out that the annual maximum deduction is going to be $12,000. To keep things simple, let's assume that the car's driven 100% for business. Now, we have to compare the deduction against the luxury auto limits and take the lower of the two numbers for the year. So in this case, in year 1, we're fine taking the bonus depreciation of $20,200 because our deduction is $19,200. But check out years 4 and 5. The luxury auto limit is lower than when we actually initially incurred that deduction. And so that means that in future years, we're limited to the maximum deduction of just $6,960 per year. So to fully depreciate a $60,000 luxury car, it's going to be a lot quicker with bonus depreciation than without. Now think about how to make the decision here in which bonus depreciation to take and how it's going to impact the tax bill. More depreciation up front means less tax now, but less deductions in the future. If you're in a low rate now and a higher rate in the future, you may prefer to save that deduction for a year where taxes are going to be higher. Now, with all things being considered equal and the fact that we don't know what's going to happen in the future, you generally want to side on taking those bonus depreciation deductions first. A bird in the hand is worth more than two in the bush, is how the saying goes. Now, if somewhere outside your home is your primary office, then you can still deduct any business trips that you take to and from the business office itself. But here's the thing, commuting mileage between your home and your office is usually not deductible. But where there's a will, there's a way. So let's talk about this little power move that can help increase the mileage deduction. There are certain types of errands or stops that you can do in the middle of your commute that can turn it from a non-deductible commute to a deduction on your tax return. The IRS has two types of stops, temporary and regular. Temporary stops turn your driving into deductions. Regular ones don't. So if you have a home office as your primary place of business, it allows you to deduct all the miles from the time you leave your driveway. Now, if home is not your main office, all business trips starting from the office itself still qualify, but remember, commuting expense is considered personal and not deductible. Okay, now that we've laid the groundwork, we're ready to move into the actual deductions and how they work. Depending on which method, both of them gives you deductions for both the cost of purchasing your vehicle and for the costs of driving it and operating it. Each business stands by itself, meaning there are many scenarios that will determine which businesses are eligible for a full deduction, a partial deduction, or no deduction at all. So let's go through a few quick examples. Let's say that your client is driving 20,000 business miles with the standard mileage rate being 65.5 cents this year. You multiply that and you'll get a deduction of $13,100. Now imagine you have a company that bought a lot of delivery trucks or 18-wheelers. An 18-wheeler can easily cost $250,000 or more. If a $33,000 vehicle took 5 years to depreciate, think about how many years it would take to deduct that 18-wheeler. That seemed ridiculously long, so many of the large corporations got together and did some lobbying to help fix this issue. And the IRS changed the rule. We used to be able to write off up to $500,000 in the same year under 179. Now you can write off $1,060,000 in a single year. So what resulted from their efforts was that there are some vehicles that legally skirt all the deduction rules, no luxury auto limitations. The real winners here are qualified vans, trucks, and SUVs. When someone buys a qualified truck, they're eligible to deduct up to 100% of the purchase price in the same year that they buy it. That's right, they get their dollars up front instead of quarters over time. Here's how it's done. If the truck qualifies, then it can be written off up to 100% of the cost by multiplying the business usage for that year. And it only works in the first year. So here's how it works. Let's say there's a $50,000 qualified truck and it's driven 90% for business. Then you can deduct 90% times $50,000 or $45,000, and that becomes the deduction. You bypass all the luxury limits and the time restrictions. So it's a really powerful strategy to take advantage of. If you really want to take advantage of this strategy, let's say that the car is purchased on December 31st. You can measure the business use percentage on that last day of the year, and let's say that it's 100%. Well, then you can write off 100% of the cost of the vehicle. So you'll often hear people using a Hail Mary strategy of telling clients to go out and purchase a car, but if it's not something they were going to do anyway, does it really help them lower their tax bill in the end? Well, it depends. So for people that are in the market for a new car anyway, use this strategy. It'll help boost the business use percentage and turn into a bigger tax break. Let's talk about what a qualified truck is. Now, it has to be built on a truck chassis. It must be new to you, offer no rear seating, at least 6 feet of cargo area, and have a 6,000 pound or more gross vehicle weight. Now let's talk about an SUV or a van. In order for that to qualify, the vehicle must be new to you. It has to be able to carry passengers, which means there must be rear seating, and it must have a gross vehicle weight of 6,000 pounds or more. Now the real tax winner here is when you buy qualified vehicles. So just to give a short review, most cars are depreciated over 5 to 6 years and are subject to the luxury auto limitations. Qualified trucks have a potential 100% write-off, and qualified SUVs have a potential bonus depreciation, and that amount is 80% for the first year. Now there's so many things to talk about with green vehicles, and that would take up more time than we have for this course. Just know that the Inflation Reduction Act of 2022 has all kinds of tax credits available for energy efficient vehicles. So you'll have to check that out to get all the details, because I can only touch on it briefly here. Now, while we've had a clean vehicle credit for some time, this credit was recently modified, and the revised credit applies to vehicles that were placed in service after December 31st of 2022, and it terminates in 2032 at the end of the year. The vehicle must be propelled by electricity with at least a 7 kilowatt battery or hydrogen fuel cell. So the credit is $7,500, and that's a tax credit, which is a direct reduction of your tax dollar for dollar. Now it's broken up into two components of $3,750, and you must meet the requirements to earn one or both of those credits. So the first one is that you have to meet critical minerals and battery component requirements. They have to be built with the correct types of materials. The second component is that the final assembly must occur in North America. Now there's no more manufacturer limits, so the old rules that applied before 2023, you don't have to worry about anymore. Now there are limits on the manufacturer's suggested retail price, or MSRP, and it cannot exceed $80,000 for vans, sport utility vehicles, and pickup trucks. And it cannot exceed $55,000 for all other vehicles. Now there's also a limit there for taxpayers of high income. So if we have a taxpayer's modified adjusted gross income and it exceeds $300,000 for joint filers or $150,000 for single filers, then there's either no credit allowed or a reduced credit amount. The taxpayer is going to use the lesser of modified adjusted gross income in the current tax year or the modified adjusted gross income in the immediately preceding tax year. How do you know which to use? That's a planning opportunity to do the analysis to see if you can help someone qualify easier. Now, I want to give you a small tip. And this tip is that switching the method of how you deduct your vehicle is only allowed from the standard rate to the actual method. You actually can't go the other way around. Now, generally we find that the actual method provides a larger write-off, but you can do that analysis as part of your tax planning service and get paid to determine what's going to work out better for your client, which will ultimately save more in tax. Now, regardless of which method that you use to deduct, remember that you can always deduct interest on the loan to purchase the vehicle, your sales tax, parking, and tolls. So even if you're using the mileage amount, you add those deductions on top. Both the standard and the actual expenses methods require a taxpayer to keep a mileage log. So don't think just because we're doing the standard deduction, you can avoid the documentation rules. And that can surprise a lot of taxpayers. So if you're claiming this auto deduction, then you have to have a log. That's what's used to prove the business usage. In fact, every year when you sign the tax return, both as the preparer and as the taxpayer themselves, you're swearing under penalty of perjury that you have written records to prove the business driving. So think about that for a moment. How can you ensure that your client is actually maintaining the required documentation? We can't, really. So it requires a change in how you're running your business. You might think about meeting with clients throughout the year to inquire on whether or not they're maintaining those logs. It helps to keep people more accountable, and that way your license is not on the line. I'd like to briefly touch on a few other deductions that you can take advantage of whether your client is a business owner or just an individual filer. And those are the medical mileage, moving mileage, and mileage related to charity work. For medical and moving, the rate this year for qualified and active armed forces members is 22 cents per mile. You're also allowed 14 cents per mile for charity. So a lot of times when I see parents who are driving to pick up scouts or they're volunteering to sell Girl Scout cookies, I think to myself, they should be claiming 14 cents per mile. Now you might think that's strange that I'm talking about that to myself, but that's just how my brain works. I have a friend who sings in his church choir, and every time he goes to practice, he's able to deduct the 14 cents per mile. Most people aren't going to do this, and you'd be surprised how quickly that mileage adds up, and that's all worth tax savings. Let's talk a little bit about documentation. I refer to this as an alibi. Have you ever seen a spy show or perhaps a true crime show on TV? And when they're trying to solve a crime, the first thing a detective asks is, what is your alibi? Now you tell me, I'm going to give you an example. Let's say that you're going to the movies and something happens while you're gone, and the detective says, what is your alibi? Which do you think is a stronger alibi? Saying that you were at the movies, or saying that you were at the 10 p.m. showing of Jurassic Park and here's my ticket stub from attending that movie? The same thing is true with our clients in helping to support these types of deductions. So the mileage log is a really important part of this, and it must include some key information. So each time they're driving for business, they have to write down or report the date of the trip, the total mileage, the beginning and ending odometer readings, the address of where they're going, and most important, the business purpose for that trip. Now the question often comes up, Do I need to track all of my mileage? And the answer is yes. There are some other methods, but generally you should track every single mile that you drive and do it year round. That makes sure that you don't miss anything, and that's easier to prove in court as well. But there are other acceptable methods that some people like to use, where you can keep a perfect log for 90 consecutive days, which is a quarter of the year. Then you simply multiply that by 4 to get an annual estimate. The reason I don't like this method as much is that you have to be able to prove that your business is not seasonal, that it's relatively similar throughout the year. So let's say you have a flower shop as a client. They probably do the majority of their deliveries between Valentine's and Mother's Day. So a flower shop definitely wouldn't qualify to use the 90-day method. But let's say you're working with a business that drives steadily all year round, then they could actually get away with the 90-day method. They just need to keep a really detailed appointment book, because even though you can prove the mileage, you still have to record the address of where you're going and the business purpose and the date the trip was taken. So emails can be helpful in backing this up, calendars and day planners as well. Now, if you're looking to really boost the miles that qualify for business, consider making your home office your primary place of business. Remember, personal commuting miles are not deductible. So if you have another location where you conduct business, you could be losing all of the miles you drive from home into your first office of the day. Now, it's possible to make your home office your primary place of business even when you have a second location from which you work. And here's how you do it. It depends on what work you're doing when you are at your home office. So as long as you do the majority of your sales and administrative work from home, from your home office, then you can qualify for your home to be your primary place of business. Now, one other requirement, let's say that you can't answer the first question affirmatively. The second question says, do you not have another office that you commute to for significant administrative work? Either of those methods will allow you to have your home office qualify as your primary place of business. And now when you drive into your secondary office, all of those personal miles magically transform into business and your deduction increases. Now, I'm sure you get asked a lot if it's better to sell the car, trade it in, or donate it when people are able and ready to move on to a new vehicle. There's some instances where trading in a vehicle would be better than selling it. But under the latest tax laws, you're almost always better off selling the car versus trading it in. The difference depends on whether or not you're going to have a loss or a gain when you dispose of your vehicle. So the first step is you have to calculate whether or not you have a gain or loss and how much that gain or loss is. So you're going to take your sales price minus your basis, and if that amount is negative, the better recommendation is to sell or trade. If that number is positive, you should sell to get the cash. Now, there will be a little bit of tax due on that gain, but it usually works out better when you calculate the overall tax savings. Here's the reason. The reason is that when you sell your car, you've got to either recognize that gain or loss, and typically the gain is going to relate to recaptured depreciation. So if you have a gain, you're going to have to pay those taxes on it, but you do get to use that deduction on your taxes. Now, here's an alternative. The question about donating a car. When someone asks if they should donate the car, the answer is probably not, because it almost never works out in the favor of the taxpayer. And that's because even if the car has value, usually that depreciation that's been taken wipes out the actual tax deduction in the end. So you'd probably be better off to sell the car and donate that money to the charity. In addition, it really depends on what the charity is going to use the vehicle for. Many charities simply auction off the vehicle to raise cash for their functions. They rarely use the car for the organization's purpose. And for this reason, the taxpayer is only eligible to deduct the amount that the charity ultimately receives for that vehicle at auction, which might not be very much money. Now, if the charitable organization is going to use the vehicle as a vehicle in performing its mission, then you can actually deduct the Blue Book value or the fair market value for the amount of the donation. Now, you probably also get asked a lot about leasing versus buying, so let's talk about that. The client is going to be better to buy if they get great terms, if they keep the vehicle for over 4 years, or when they're driving over 15,000 miles per year, or when the vehicle weighs over 6,000 pounds. There's a few reasons to lease a car. The primary reason is if you're dealing with a person that likes a new car every 2 to 3 years and they always want the latest and greatest model. It's not the best financial decision, but it is a decision that many people like. From a strictly financial standpoint, they're probably okay to lease if they've got bad credit that causes them to get bad terms on the car loan for purchase, or if they drive less than 15,000 miles total per year, then it might make sense. Now, if they're driving more than that, they might get hit with lease penalties that can really hurt financially. One thing to consider, though, is how the IRS treats the luxury auto limitations in a lease. When you lease a luxury auto, you're required to add back an amount each year that effectively reduces your deduction. It's known as the lease inclusion rate. Now, here's where the magic comes in. For the lease inclusion rate, the IRS publishes tables each year in which you look up the year of the lease and the current fair market value of the vehicle. The lease inclusion rates generally end up being way smaller than the adjustment that's made for purchasing a luxury vehicle. So for your luxury vehicle clients, the lease might be a better way to get a larger write-off. I hope this helps give you some ideas on how to share this with your clients and get them eager about working with you to save tax. If you're looking for more ways to save them tax, or you're looking to implement tax advisory services in your practice, check out the website on the next page.